Welcome back. Lesson 4, price changes. In this video, we're going to cover the reason behind the stock market prices change. In economics, there's a supply and demand theory. And based on this theory, the price of products change. For example, if the supply of a product is excessive and there are not that many buyers, the seller will decrease prices to ensure the items can be sold. Now, if the supply of these items is low, but there are many buyers that want to get this item, the price will increase because the buyers will start fighting over the price so they can buy it. I'll give you the best example. Imagine there's only one store in the entire world that sells a pair of shoes. And the store for the next 90 days only has one pair of shoes that can be sold. There are outside factors that may have caused for that one specific shoe store to be the only one available in the entire world. What do you think the price for that pair of shoes will be? Excessive, right? Even if it takes $20 to make or $10 to make, the price will be excessive because there's only one pair of shoes left. And everyone in the world needs a pair of shoes, right? So when all these people show up to the store, you're gonna hear different prices. I'll pay 100, 150, 200, 1,000, a million, 10 million, 100 million. All these people will be bidding for the pair of shoes. That is supply demand at its core. And it's the same thing that happens to the stock prices. When there are a lot of buyers of a specific stock at the marketplace and there are not enough sellers, those buyers are going to start bidding higher and higher to get the products they want, the stocks they want. Now, if there are more sellers at the marketplace than buyers, those sellers will be competing and decreasing the price to ensure they can sell the product. And each of these individuals have their own reasoning and their own internal beliefs as to why the price of a stock should be at a certain level. It's called speculation. They're speculating what the price of the stock will be, or should be, or ought to be. And they make decisions, internal decisions, whether to buy or sell based on their own personal beliefs. That is supply demand. Those internal personal beliefs of all these individual players within the financial marketplace, when they act on those beliefs, whether to buy or sell, causes the prices to change. Think about it. If there were no players in the financial marketplace, the price of a stock will be flat, will be a straight line. There wouldn't be any buying, there wouldn't be any selling, it would be just flat. But due to the humans, the individuals' own personal beliefs and greed and fear, they make decisions that executes into the financial marketplace a buy or sell that causes the price to change. In summary, now you should understand that the financial marketplace involves humans making their decisions for themselves based on their own internal beliefs and their own personal emotions. They make decisions whether to buy or sell a stock and the amount they want to buy or sell for that specific stock that causes prices to change. There are outside factors that do influence people's behavior, human behavior, in either buying or selling a specific stock. It could be news articles. It could be a company posting their earnings. It can be government changes somewhere in the world. It may be a war. It may be a conflict. It may be economical issues. It could be employment. It could be family increasing or decreasing. It doesn't matter. It's many factors that can cause any of these humans to make a decision that affects them, and it affects the market overall. You have to be cognizant of this human behavior that nobody knows for everyone. In other words, there's not one trader that can determine the human behavior of every other trader. It is impossible for one trader to know what every other trader involved in the future transaction are going to do. Thank you. I hope you liked the video. If you did, please smash that like. And if you have not subscribed, please do so.